Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Fidelity's aggressive target risk ETF model portfolio. Now, the goal of the portfolio is simply to provide exposure to global equities and pursue an aggressive growth strategy. So there's no fixed income, no money markets, no alternatives, nothing like that. Let's have a quick look at the holdings. So we do see there is about 8 ETFs and a little bit of cash. We do see that it's primarily Fidelity ETFs, but there's also some ETFs from other managers. So it's great to see, right, that they also use third-party asset managers. We do see that the largest allocation is to, well, an ETF that provides international exposure, 20%. There's a large cap core ETF, this is US stocks with 17%, and a blue chip growth ETF with 16%. Now, the suggested benchmark for this portfolio is the MSCI ACWI Index. So let me select that. It is worth mentioning that the fact sheet for this model portfolio does not feature any track record. What we can only do is compare the performance of the current holdings to this benchmark index. And what we see effectively is that Fidelity's aggressive target risk ETF portfolio has tracked the MSCI ACWI Index very closely. And the index kind of makes sense because this portfolio is comprised of US stocks, international, and emerging market stocks. We could quickly check in terms of how similar or how different this portfolio is to the benchmark index. And here we see it's a 100% equities or almost a little bit of cash. We do see that Fidelity's portfolio has a slightly lower weight to the US, slightly lower weight to large caps, and also from a country perspective, slightly lower weight to the US. If we change the perspective to a sectoral one, we do see that the Fidelity portfolio has an underweight in tech stocks and a slight overweight in industrials. Now, changing the perspective from going from sectors to factors, we can see if this portfolio had significant factor exposures over time. And here we can see, of course, the beta to asset classes has been, to the S&P 500 has been close to 1, right? It's an all equities portfolio, not surprising. We do see that there's been relatively consistent factor exposures. So we can see that there's been exposure to the value factor, to momentum that was almost consistently positive. So the stocks were cheaper and have been outperforming. There's been almost consistent negative exposure to low volatility and quality, meaning the stocks were a little bit more volatile and low from a quality perspective. Having said that, if you look at this from a resources perspective, we can see that almost all of the risk of this portfolio is explained by the stock market and that the equity factors really didn't matter. And that's kind of interesting to think about because if we can go back to the holdings, we do see large cap core, blue chip growth. So blue chip growth, right, would would indicate that this is something like quality themed, right? There's large cap value in here, right? There's also fundamental small cap. So there should be some factor exposures here, right? And unfortunately, what we see over here is what we come across in many portfolios, that Fidelity is combining funds with opposing factor exposures. So for example, the blue chip growth ETF has a positive beta to the quality factor, 0.36. But there's also this fund from Putnam, which is a large cap value ETF, and that has a negative exposure to quality factor, as expected for value stocks. Problem, of course, is if you combine positive and negative, the factor exposures net themselves off, and therefore the portfolio on a total basis has very small factor betas. And so that's why the resources analysis shows that factors didn't really matter for this portfolio. And problem, of course, is that you pay higher fees for these funds, than for just plain vanilla equity. And if the factor exposures net themselves off, you're just left with equity again, albeit at higher fees. Talking about fees, right? We can investigate if you can reduce the fees of this portfolio. This portfolio has a total fee of 32 basis points, so it is cheap, right? But we do see, right, that, so for example, here is a Fidelity Enhanced International ETF that is charging 28 basis points. And we could replace that with an iShares, MSCI ACWI ETF for 7 basis points. And pretty much any position in this portfolio can be replaced with a cheaper benchmark ETF, which would move or reduce the cost from 32 basis points to 8 basis points. Having said that, actually Fidelity's portfolio, right, has slightly outperformed. So in this case, you could argue that it was worth paying higher fees. Finally, there's a question, right? Is it worth having 80 ETFs for getting exposure to global equities, right? And we've already seen that some of these conflict the holdings, right? So could this portfolio be simplified? And the short answer is, of course, yes, right? Because we saw earlier that effectively this portfolio tracks the MSCI ACWI. And so instead of allocating this portfolio with 8 holdings, right, where you need to think about how do you allocate to each of those, right, that what makes sense, right, in terms of the factor exposures, right, because your current constellation doesn't. Instead, you can simply buy the MSCI ACWI from iShares, which is costing you something like 31 basis points, or there is a similar product from Vanguard VT, which is charging 7 basis points. And that kind of concludes our analysis of Fidelity's aggressive target risk ETF model portfolio. So as discussed, this provides you simple exposure to global equities. Having said that, it does that in an unnecessary, complicated way via 80 ETFs and a bit of cash. We've seen these conflict effect exposures, which effectively anything this is off. And so end of the day, you're just left with, well, MSCI ACWI, right? And you can just buy one product instead of allocating this portfolio. Hope that helps. Have a nice day.